Have you noticed that high quality is now a luxury and basic is becoming expensive? It's not just inflation. Think back to 1999. In a suburb outside Des Moines or a flat in London, you could buy a TV that was thinner, sharper, and cheaper than the one before. We called it the Great Deflationary Miracle. We were told globalism was an unstoppable force that would drive prices down forever. But looking back, that $5 t-shirt and that $400 TV weren't a triumph of capitalism. They were a glitch in history, and that glitch just ended. But as we sit here in 2026, the silence in the aisles of our big box retailers tells a different story. The price tags are no longer falling. They aren't even stabilizing. They are climbing. And they're doing so because the structural pillars that held up the world of cheap everything have finally buckled. We're witnessing the great reversal. For 3 decades, the West exported its inflation. We sent our capital and our blue-collar jobs to the East, and in return, we imported stability and low prices. We effectively outsourced the messiness of industrialization to places where labor was an infinite resource and environmental regulations were a secondary concern. It was a beautiful arbitrage, but it was also a temporary one. In the lexicon of high finance, we often talk about transitory shocks, interest rate hikes, a bad harvest, a brief war. But what we are facing now is not transitory. It is structural. The China price, the global benchmark for the lowest possible manufacturing cost, is dead. The labour pools of Asia are greying and shrinking. The just-in-time logistics model, perfected by Toyota and adopted by the world, has proven too fragile for a deglobalizing planet. And the geopolitical peace that allowed a container to travel from Shanghai to Los Angeles for pennies is fracturing into a new era of fortress economies. To understand why your morning coffee, your smartphone, and your car have become luxury items, we have to look past the headlines of the day. We have to look at the plumbing of the global economy. We are moving from an era of efficiency to an era of resilience, and resilience is, by its very definition, expensive. This isn't just a spike in the cost of living. This is the end of the world as we knew it. This is the hidden cost of the new supply chain. The demographic tax. In the high offices of Manhattan and London, there was a long-standing myth that the world possessed an infinite supply of 20-somethings willing to work for $5 a day. For 30 years, this myth was our reality. It was the demographic dividend, a massive bulge of young, productive workers in China and Southeast Asia that acted as a global shock absorber for inflation. But biology is the one ledger you cannot cook. In 2026, the world's factory is no longer young. China is aging faster than any civilization in human history. Every year, millions of workers exit the labour force, and there are not enough young hands to replace them at the assembly line. This is the demographic tax, and it is being levied on every consumer in the United States. When labour becomes scarce, it becomes expensive. In the early 2000s, a manufacturer in Shenzhen could replace a disgruntled worker in 10 minutes. Today, that same manufacturer is fighting a wage war. To keep the lights on, they must pay more. To pay more, they must charge more. The China price, which once suppressed global inflation like a heavy blanket, has become a thermal vent. The common retort from the chill optimist is simple. Just move the factories. Move them to Vietnam, to India, to Mexico. But the math doesn't hold. Vietnam's entire population is less than 10% of China's. India has the numbers but lacks the infrastructure, the ports, the power grids, the seamless bureaucratic on-ramps that Beijing spent trillions building. Mexico is booming, yes, but its labor is already priced in dollars and integrated into North American wage scales. There is no new China waiting in the wings to save us. We have reached the bottom of the well of cheap human effort. This brings us to the great automation paradox. Facing a lack of humans, the world is turning to silicon. But robots are not cheap in the way a migrant worker from a rural province was cheap. A robot represents a massive upfront capex capital expenditure. It requires specialized technicians to maintain, a stable high-voltage grid to run, and a massive amount of high-priced semiconductors to think. When you replace a $5 a day worker with a $100,000 robot, you aren't lowering the floor of the cost of goods, you are raising it. You're trading variable labor costs for fixed capital costs. You're making the supply chain more efficient in terms of output, but far more expensive to build and insure. The deflationary pressure of the limitless worker has vanished. In its place is a rigid, high-cost infrastructure that demands a return on investment. We're no longer paying for the sweat of a billion workers. We're paying for the interest on the loans that bought the robots. And in a world of 2026 interest rates, that tax is passed directly to you. The geopolitical premium. For 3 decades, the world operated on a single, ruthless directive: efficiency. Capital moved like water, seeking the path of least resistance. If a factory in the South China Sea could shave 3 cents off the cost of a plastic housing, the supply chain moved there. This was the era of the global commons, a period where we assumed the seas would always be open, the borders would always be porous, and the rules-based order was a permanent law of nature. In 2026, that era is a memory. We have replaced the efficiency directive with the security directive. We're witnessing the birth of the geopolitical premium. It is a surcharge on the modern world, paid by every consumer to ensure that their goods don't disappear in the event of a blockade, a coup, or a Cold War turning hot. The most visible front of this war is etched in silicon. For years, the world relied on Taiwan for over 90% of its advanced logic chips. It was the ultimate efficiency, a single, highly optimized island producing the brains of the global economy. But in 2026, concentrated efficiency is just another word for strategic vulnerability. As a result, we're seeing the most expensive industrial migration in history. Under the recent US-Taiwan trade agreements, over $500 billion in investment is being poured into American soil to build domestic chip capacity. But here is the chill reality. Building a semiconductor fab in the United States costs roughly double what it cost in Taiwan. It takes twice as long to build, and the labor required to run it commands an American salary, not a Taiwanese one. When we friendshore or reshore our supply chains, we aren't just moving factories, we're abandoning the low-cost ecosystems of the past. We're trading the $2,000 efficiency chip for the $4,000 security chip. This premium extends beyond the factory floor to the very water the goods travel upon. The global commons are no longer free. Between the insurance spikes in the Red Sea and the mounting risk premiums for trans-Pacific shipping, the cost of simply moving a box from point A to point B has decoupled from the price of fuel. It is now tied to the price of protection. In the 1990s, we were told that trade would prevent war. In 2026, we have realized that the fear of war has made trade prohibitively expensive. This is the new Iron Curtain of the global economy, a world divided into trusted and untrusted zones. Security is a luxury, and in the new supply chain, you are the one paying the bill. The Greenflation. There is polite fiction in the halls of global policy. that the energy transition is a simple swap of one fuel for another. We're told we're moving from a dirty system to a clean one. But in the cold reality of 2026, we've discovered that the transition is not a subtraction. It is a massive, mineral-intensive addition. We're moving from a world fueled by liquids to a world built of solids. And solids are much harder to find, extract and refine. To build a single electric vehicle, you need roughly 4 times the copper of a traditional car. To build a wind farm, you need miles of specialized wiring. To store the sun's energy for a rainy day, you need gigafactories worth of lithium. This is Greenflation, the structural rise in prices caused by the sudden, simultaneous rush of every developed nation toward the same narrow list of raw materials. As of early 2026, copper, the connective artery of the modern world, is trading at record highs. Analysts at JP Morgan and S&P Global are warning of a structural deficit that cannot be innovated away. Why? Because it takes an average of 17 years to move a copper mine from discovery to production. We're trying to build a 21st century grid using 20th century mines. The math simply does not work. And then there is the white gold rush. While battery technology has improved, the floor for raw material cost has fundamentally risen. In 2025, we saw lithium prices double in a matter of months as energy storage demand outstripped even the most aggressive supply forecasts. But the green in Greenflation isn't just about the scarcity of rocks, it's about the cost of compliance. In 2026, the untrusted supply chain is being penalized. New carbon border taxes in Europe and the US mean that if your steel was made with coal in a country with lax regulations, it arrives at the dock with a massive surcharge. We're no longer allowing the environmental arbitrage that made the 1990s so cheap. We're finally pricing in the planet. The result is a paradox. To save the environment in the long run, we're making the world significantly more expensive in the short run. Your green lifestyle isn't just a moral choice, it's an economic burden. The cheap energy of the fossil fuel era is being replaced by the expensive, mineral-dependent infrastructure of the future. The green revolution is here, and it's going to cost you. The hidden costs. In the golden age of globalisation, the ocean was a frictionless medium. We spoke of global trade as if it were a digital file instantly and effortlessly moved from one hard drive to another. But in 2026, the physical reality of the sea has reasserted itself with a vengeance. We are discovering that the plumbing of the world is not only aging, it is becoming increasingly dangerous and expensive to maintain. These are the hidden costs, the surcharges that never appear on a sticker price, but dictate the inflation floor of the entire West. The first hidden cost is protection. For decades, maritime insurance was a boring, low-margin business. Today, it is a geopolitical barometer. In the Red Sea and the South China Sea, war risk premiums have surged. In 2024 and 2025, we saw these premiums spike by over 1,000% in certain hot zones. Even as some routes cautiously reopen in early 2026, the baseline has shifted. Insurers no longer view the global commons as safe by default. They now charge a security tax on every container that passes through a choke point. Then there is the shadow fleet. To bypass Western sanctions, a massive dark fleet of aging, uninsured and poorly maintained tankers has emerged. These ships operate outside the transparent market, effectively hemorrhaging available tonnage from the legitimate pool. This creates a brutal supply-demand imbalance. When 700-plus tankers exit the clean market to serve sanctioned regimes, the remaining legal ships can command historic premiums. In 2026, tanker rates remain at levels that would have been unthinkable 5 years ago. Whether you're buying gasoline or plastic, you're paying for the scarcity created by this bifurcated sea. Finally, we must account for the inventory tax. The just-in-time model was a miracle of cost saving. It allowed companies to hold almost zero stock, relying on a perfect rhythmic supply chain. But in a world of Red Sea diversions and port strikes, just-in-time is a recipe for bankruptcy. In 2026, the world has pivoted to just-in-case. Companies are now building massive warehouses and over-ordering stock to buffer against the next disruption. This is dead capital. Money that used to go toward R&D or lower prices is now sitting in a warehouse in New Jersey, tied up in safety stock. The hidden costs are the friction of a fragmenting world. Every time a ship diverts around Africa, every time an insurer raises a rate, and every time a CEO decides to hold 6 months of extra inventory, the price of everything ticks upward. The miracle of the 1990s wasn't just trade, it was the absence of friction. In 2026, the friction is back, and it is permanent. The new reality. We have spent the last 30 years living in a historical anomaly, a brief window of time where geography didn't matter, labour was infinite, and peace was the default setting of the global machine. In 2026, the standard of living reset is no longer a forecast, it is our lived reality. The new reality is not a temporary dip in the business cycle, it is a fundamental repricing of existence in the West. The first hallmark of this new era is the death of the impulse purchase. In the era of cheap everything, we treated global supply chains like a magic trick. Products appeared instantly and vanished into landfills just as quickly. But as the geopolitical premium and Greenflation settle into the bones of the economy, the cost of stuff is reclaiming its historical weight. We're moving away from a consumption-driven economy toward a maintenance-driven one. When a smartphone costs 40% more than it did 5 years ago, planned obsolescence is no longer a viable corporate strategy, it's a consumer insult. We are seeing the return of quality, durability, and the secondary market as primary economic drivers. But there is a darker side to this reset, the K-shaped reality. In 2026, the gap between those who own the robots and those who serve them has widened into a canyon. For the top 10%, the end of cheap everything is an inconvenience and a reason to complain about the price of a Tesla or a flight to Tokyo. But for the middle and working classes, this is a standard of living tax that eats into the very foundations of the American dream: home ownership, education, and retirement. We are seeing a world where luxury is being redefined. It's no longer just a logo. It's the ability to opt out of the volatility to have a resilient life that isn't dictated by a blockade in the South China Sea or a copper shortage in the Andes. So, where does this leave us? The retro ledger takeaway is this: the end of cheap everything is actually a return to honesty. For 30 years we ignored the environmental costs, the geopolitical risks, and the demographic time bombs that made our lifestyle possible. We were living on borrowed time and borrowed labour. The new supply chain is more expensive because it is more real. It reflects the true cost of security, the true cost of carbon, and the true value of human work. The era of the miracle is over. The era of the resilient has begun.